Hello and welcome to InvestFlow. Today we will be taking a look at my personal portfolio and what changes I did in March and how I performed. I did quite a lot of things in March and it was a quite eventful month in general. And also I have a new microphone, so I hope the quality is a lot better now, so let's get into it. First I want to talk about the goal of my portfolio. Then I want to go into the categories of companies I invest in. I will take a look at my buys and sells of the month. Of course, I will talk about my performance and also reveal my full portfolio and how it changed in the last month. Then I will also talk about the dividends I did receive, the checklist of companies I own, but I'm checking up on the how they're doing, and then last but not least, my watch list. I think it's very important to have a goal in mind with every portfolio. So my goals for the portfolio is to build wealth over time, and I do not focus on dividends for that. I want to have high convictions in my holdings so that I can sleep well at night, because if you own a company and don't know what it's doing and what it's about and why the stock is falling and all that stuff, then you will not be happy with it and you will stress way too much and do bad decisions. So having a high conviction and concentrated portfolio is key in my opinion. And eventually all of this should result in financial freedom down the road. I have 5 different categories of companies I invest in. The biggest category is American tech. So that's pretty much any technology company that's based in the United States. These make up 1/3 of my portfolio. Then the second biggest category is almost the same size with 32%. Those are great capital allocators. These are mostly mature companies that are still growing at a decent pace, that have a long track record of great capital allocation, so they generate a lot of cash flow and know how to reinvest it. Then I also have 23% of, in the most cases, unprofitable high growth companies. I have 4% left in China, and then I also have a category for everything that doesn't fit in these 4 categories. So let's take a look at my buys in March. I just today actually opened a new position in Domino's Pizza. I recently listened to a podcast and then started to find interest in the company. It's a great play on the whole pizza industry, the delivery and takeout industry. And Domino's manages to get a market leadership position and get a good moat in pricing and also speed of delivery and customer satisfaction by leveraging technology and scale to their advantage. They also have a great track record of raising the dividend by around, I think, 15 to 20% every year. And they have been great at compounding their cash flows and opening new restaurants with their franchising model, which has very nice margins for the business. And due to the franchising model, it's also very asset light. The second company I did buy is Sartorius. I already owned Sartorius, so this is just a subsidiary with the most interesting part of the business. So I decided to do a comparison between these two and came to the conclusion that the biotech segment is the far more interesting one compared to their laboratory equipment. And then the last company I did buy more shares of, so already did own them before, is Adobe. Besides my normal buys and sells, I also do dollar cost average into some of my favorite companies every month. So I did dollar cost average into Alphabet and Amazon. Those were my biggest saving plans for the month. I also bought some Texas Instruments and Constellation Software. Those are all part of my tier 1 companies. Those are my highest convictions. Then I also bought some more of C Limited, Salesforce, and also Adobe. If you're wondering why Adobe is here in the saving plan and the normal buying segment, that's because I did buy them on weakness after earnings once again. So I did buy them twice in a month actually. I also sold 2 companies. Like you probably would already have guessed, I did sell Sartorius and decided to buy the subsidiary Sartorius that in biotech. So pretty much Sartorius owns 74% of the biotech holding, and the other 24% are the lab equipment branch of the business. And I just did a comparison, and on margin and growth potential and just in general, the biotech segment is just way more appealing in my opinion. And I also have Danaher as another play for the lab equipment branch or segment, so I decided to just get the biotech one instead for Sartorius. This means also that I don't have a single German company left, since Sartorius Stadim is listed in France, so that's also interesting, so no home buys for me there. The second sell I did was Nintendo. I did sell out of the hold position, and let's take a look at why I did that. I did take some notes on why I did sell Nintendo. So my original invest case was based on diversification of revenue via mobile, parks, movies and other IP plays. They also had a very low PEG ratio. They started doing subscriptions and long-term monetization and also did add DLCs to their games. And they started to migrate more sales to digital. So this was my initial investment thesis, because right now around 99% of revenue is based on the Switch. And then I went over the stock again and found a bunch of problems, like the management. I started to look a lot more onto management and how they can use the money to invest back into the business or do buybacks or stuff like that. And the Nintendo management is just way too conservative and not really shareholder friendly. And social media presence is also terrible. As a gaming company, you should allow people to make videos about your games, because it's basically free advertisement. So, and also like esports, they cracked down on some tournaments and blocked them from doing the whole thing. So that's just not really the management mindset I would hope to see in an entertainment industry company. So yeah, they're slow on trends, and the question is, could the Switch be at their peak? And for that, I also took a look at the projections from analysts. It's in German, but basically this is the revenue, and the projections are that they should have peaked in 2021 and should roughly trail for the next years and slightly decline. The earnings per share is also expected to decline on a roughly 10% decline over the next 3 years. So I don't really have the whole low PEG ratio thing anymore, since they are expecting to have negative growth. So that part of the thesis is gone. The diversification part also is gone pretty much, because when I started investing, I looked back to 2018 and they had 3% of sales in the whole mobile parks and so forth category. And now it's still at the same 3% level. And mobile games aren't really taking off. The parks didn't contribute anything. I don't think the movies will significantly shift it in the right direction either. So that part also isn't really working out. Subscription and long-term monetization and DLCs is working decently, and migration to the digital sales as well. But they are still just at 30% of digital sales, while competition is at like 80%. It's just way too slow of a movement, because the cost advantage of digital is just way too high. And then I did also notice that people also always talk about how good the Switch is doing, but for some reason people seem to ignore that Nintendo used to have 2 different systems out in the past. Like back in the days you would have a Game Boy and a home console. Now the Switch is both, pretty much. So they might have higher system sales for the Switch, but they don't have a second system to sell, so I don't know. Then they also have $13 billion in cash on a a $60 billion market cap. So that's way too conservative, and they could be doing share buybacks or do something with it. I think they bought like 1%, like 2% of shares back, but that's nothing considering the cash stack they have. So yeah, overall I just don't like what management is doing, and I don't know, I think I just had way too much nostalgia put into the whole investment too. Then I also took a look at one of the graphics from a presentation from ARK Invest. Your opinion on ARK Invest could be anything, not the thing I want to talk about here. But they have shown here that in 2010, around 80% of revenues from games was from selling the game, and only 20% from in-game purchases. In 2015, that was 50-50, and now it shifted to 75% big in-game purchases. And Nintendo pretty much doesn't do any of that stuff. They have slowly moved into DLCs, but that's also not really a big contribution yet. And I just don't see the switch fast enough, the switch to that business model fast enough. So yeah, I decided that there are better investments to put my money into. And I did sell out of Nintendo and put the money towards ASML and Amazon. Before I continue with the video, I would kindly ask you to thumbs up the video and subscribe to the channel and leave a comment down below. Let me know how the audio quality is with this microphone, and in general, if you liked the video. What did you buy and sell in the last month? In general, how did you do? In the last month, my portfolio did a 5% gain. In the middle of the month, it was down around 10%, I think. So since then has been a pretty good rally. The S&P 500 on the same 1 month time frame did a 7% gain because the drawdown wasn't as big on the whole slump here. My portfolio went down like 10% while the S&P went down for like 5%. So yeah, it outperformed me a little bit, but I'm still happy with the month overall. So this is my current portfolio. My tier 1 stocks are ASML, Alphabet, Amazon, Microsoft, Danaher, and Texas Instruments, and Constellation Software. So those are all in the top positions. The only tier 2 stock that is up there too is Teladoc. My new positions are both at roughly 4%, and the remaining ones pretty much stayed idle for the most part, besides Adobe, which moved up because I bought more of it. These are my month-over-month changes. You can see that especially Amazon and Alphabet did gain a lot of percentage here, from 5% to 7% on both. The rest of the companies stayed pretty much the same and just had the normal fluctuations. Adobe also went from 4% to 5% due to my buying of more shares. And my 2 new positions with Domino's Pizza and Sartorius Denim have around 4% each. I don't really focus on dividends, but I did receive quite a few dividends this month. I did receive my dividends from BlackRock at $4.88 per share. I did also receive 62 cents per share from Microsoft. And funnily enough, I did receive my Sartorius dividend the day after I sold them. So currently I have 8 out of 19 stocks paying a dividend, with the total portfolio yield being 0.47%. The total yield is down 9 basis points from 0.56% last month, mainly because I sold out of Nintendo, which was my highest yielding company, with around 3.5 to 4%. So now my biggest contributor, both on a yield basis and on a total basis, is Texas Instruments with 32%. I like to keep a checklist. Basically what a checklist means for me is companies in my portfolio that I want to keep an eye on and do my research and decide if I want to keep them or sell them pretty much, or potentially even buy more. So I have 3 companies in that list here. 2 of them are Spotify and Xiaomi. Both have the problem that they have very low margin business models. And I kinda am shifting to more asset light and and high margin businesses. I mean, Spotify is still asset light, but actually, I'm not even sure if it's asset light considering the whole royalty fees they have to pay to the labels. So yeah, I have to come up with myself if I want to keep low margin businesses. So that's why I'm checking up on Spotify and Xiaomi. Then I also have BlackRock here. Nothing really wrong with the company, but I just did the BlackRock analysis and went deep into the company. And the whole moral part and the whole hypocrisy kinda is not sitting well with me. Like with Larry Fink preaching about being socially responsible and good for the environment, and then investing 16 billion in a Saudi Arabian oil pipeline or something like that, and buying weapon manufacturers right after the Ukraine invasion. So the whole hypocrisy and in the whole woke culture at BlackRock is kind of rubbing me the wrong way. So I'm also considering if I might swap out BlackRock for another financial company. The other financial company I'm looking into is Moody's and also S&P Global, which are pretty much very similar companies. So those could potentially be the replacement for BlackRock, depending how my analysis goes there. And then another company I've recently started to look into is RCI Hospitality Holdings, which is a pretty weird investment considering their main business is acquiring nightclubs and operating a sports bar chain. But the capital allocation side of the business is fantastic from what I've seen so far. Their whole capital allocation strategy is based on William Thorndike's book, The Outsider CEOs. And pretty much it goes to maximize free cash flow per share, have a high return on your on your projects you're doing, and in general just good metrics on how to allocate capital well. So that sounds very interesting in my opinion. I will look more into that in the future too. So I hope you did like the video, and let me know in the comments down below how you like the microphone, if the quality is good now, and in general how you like the video.